No. My name is Craig Himmelberger. I'm with SAP's Finance and Treasury Solution Organization. I'm honored to have with me Steve Patuk, who is the channel manager for the Areva technology that's now an SAP company. And the premise of the discussion this morning is working capital, and basically how to use a different approach to working capital to make substantial changes in the return on that capital, but improvements in all the systems. So I'm going to start. I want you to look at this. I mean, one of the things that the proformative people suggested to me is that since I'm from SAP and not Procter & Gamble, that I might have a credibility issue. And I said, that doesn't faze me. I have two sons. I live with a credibility issue all day long. So one of my sons is he's kind of an instant gratification guy. Like if you don't tell him what the bottom line is up front, he tunes out. The other is the engineer of the family. Like if you don't go through it step by step and give him irrefutable proof, he won't believe what you're saying. So I'm going to try to balance the remarks here between letting you know the bottom line, but at the same time filling in. Anisha, am I vibrating a little bit in terms of feedback from the microphone? It just sounds a little bit like you may want to take the level down just a wee bit. Thank you. So we'll try to bridge the gap between the bottom line up front and the empirical evidence. And all through the presentation, Steve and I are both going to refer to a collection of data that we have through the benchmarking program at SAP, and I'll share some background on the benchmarking program. But the focus of the talk and the information that we're presenting here is accumulated learning from those 4,000 companies. So right up front, this is something that you probably already are dealing with right now, and this is a study the Hackett Group's latest, came out in June. Working capital is bloating even further. Basically, return on that capital is getting worse. It's gone up 25% in the last 3 years. This is not something that you necessarily are going to expect to change in the near future. I have some very smart people that I work with that says, yes, but isn't a large percentage of that inventory? And I said, yes, that makes the problem worse, because if you want to make a positive impact on that $1 trillion, but now the first so ever many portion of that is something that you really can't alter, you can't trade it, you can't hedge it. You got to do an even better job with the working capital portion of that working capital $1 trillion that's sitting there unused. So the main challenge here, and this is to me where that $1 trillion worth of unused capital is coming from, is that you've got increased volatility. I mean, since liquidity disappeared in 2008, if that were the only problem that we had to deal with, that would be one thing, but we really have a large degree of economic uncertainty. So that creates a vice situation where basically you need better information, better forecasts, and you need to be able to use that information to take action and change the way your working capital decisions are implemented. So this is the bottom line up front. The sum total, if we were going to boil down everything that we're going to talk about over the next 45 minutes, the sum total of that is that the way to make improvements, measurable improvements, is not just to look at a working capital system in a vacuum and try to clean it up and make it more efficient. And it's not to look at your cash and liquidity planning and treasury and try to do a better job of predicting sources, uses, and what you're going to have on hand. But it's actually connecting the two systems together. The better information to create a better liquidity forecast is in your operational systems today. Likewise, if you're sitting on a potential discount that you're going to take, knowing your liquidity to a reliable degree is going to let you know whether there's a return on taking that discount or whether you want to defer it. Likewise, do we have a finance crunch? I was having a conversation earlier today about the middle of the month liquidity crunch. You know, everybody cleans up their receivables and all the payments are clean by the end of the month, but the 15th is when everything sort of, collections are slow, payables are still going out. That's when you have the crunch. The idea is to get the process working so that your collections If you know you're going to be short on the 15th, maybe you change your terms in a way that incents customers to pay a little early. You can finance operations that way. Likewise, if you know you're going to be okay by the end of the month, you know at the 15th, even though you're running close, you know you don't have to borrow because it's all going to come back. So with that, the main silos, if you will, and this is an interesting graph because when I show this to different people inside SAP, they look at the green and the blue differently. If you are a company, your payables department is actually somebody else's receivables department, if you think about it, and vice versa. And this graph is intended to look at this in a holistic fashion. So I'm not just looking at the accounts payable department inside your company. I'm also looking at the payments infrastructure in your business partner that you're selling to. Likewise, your receivables, somebody else is selling that to you. A lot of great information about your receivables process, for an example, is sitting in someone else's system. Did they receive the goods? How do I know it? It's not my shipping dock. And we're going to spend a lot of time here talking about networked infrastructures that give companies visibility into their business partner system. Likewise, if you're setting up a voucher to be paid, that information would be very valuable to somebody's cash plan on the other side of the fence. If I'm setting up and I'm going to pay that on the 30th of the month, somebody else sees that in their system, they can amp up the reliability of that cash forecast. Say, yep, that money's coming in. If it's not in my system, and to Bruce's point, if it's not in my system on the 25th of the month, you're not getting paid on the 30th. That information is extremely valuable for your cash requirements planning. So all of this is improved when things become connected. And this is both inside the company and outside. Outside, the connections, like we were just talking about, that you have better visibility into your business partners' systems, either for collections or payments. But also inside your company, your cash requirements, very common for people to build a cash requirements plan based on their payables vouchers that are sitting in the system at any given time. There's a little frustration because if the AP people don't post it and it didn't hit the general ledger and it's not visible in the cash system, you get a lot of phone calls, hey, can you post the AP so I can see what the requirements are going to be? That's better than nothing. But if you think about it, that information is just the tip of the iceberg. What's going on in your procurement system? If I know my payables for the 15th of next month, that's fine. But what is it going to look like the month after that? And a lot of that activity does not begin from an AP voucher, it begins from purchase requisition. Likewise, on the sales side, I've got an open receivable. I might schedule or predict that I'm going to have that cash sooner or later when that's due. But if I can actually look back into the order management system, I know what my customers have ordered. I know what I'm shipping. I know what's going to turn into a receivable. That forecast gets more reliable further out. And the whole point of this is to have a very reliable confidence in what's going to be on hand. I'm going to guess if you're running a business, you've got an extra working capital. Either that or you have a lot of borrowing expense that's significant. And the way most people deal with that is they just let the pile of cash bloat. You got lots of subsidiaries, lots of companies, lots of bank accounts. You know, there's $500,000 here, $1 million there. The whole thing adds up. You're not making any return on that. So the idea is if we can connect these systems, if we can see in our cash requirements plan what's going on in these systems, not only internally with our own payables and procurement, but if I can go out into the sourcing system and I can actually see what's being shipped. You know, I have a request for quote out there and I know a customer's going to invoice me. If the further out I can see, the further this network goes, the more reliable my information. The more reliable my information, the more confident I am to take proactive action in my operational systems. And one of the things that Steve's going to be able to talk about quite a bit are discounts. There's a huge amount of money that's being made in discounts, not necessarily being recorded as return on capital, but that's what it is. Likewise, you're doing a lot of borrowing. You've got a big pile of receivables. Do you factor them? Do you offer your customers a discount to pay you early? You can finance your operations out of working capital, and this is a very important concept. So, back to my son, the engineer. So, where are we getting this information, or what are we basing this on? I wanted to take just a moment to talk about the SAP and Areva benchmarking program. The program at SAP I can speak with directly, and Steve maybe can comment on the Areva benchmark. But this is going on 10 years worth of data, over 4,000 companies, over 50 different business processes, 300 peer groups, 1,200 KPIs. So this is the information. It's not just SAP customers. Basically, we're trading data for information. You give us your data, we give you your information. Basically, it's a free service. There's no charge. The idea is if you can contribute your numbers, we're going to be able to give you back all the benchmarks from your peer group. It's a very popular program of ours, and it creates a lot of very interesting information. Like, for example, what's the opportunity for people to improve their liquidity planning? Right now, Bruce and I were joking that the 80-20 rule hasn't even been hit yet. Only 13% of companies have an online liquidity forecast that they can use in their operating units to make decisions in their working capital. Do I have cash on hand to make this payment early and take that discount? Do you call a treasurer, or as the AP manager, you just have a policy? You're either taking the discounts or you're not. Depending on that, you're either creating a big headache for your treasury, or else you're just relying on a pile of cash that's so big you get no return on it. Better forecasting enables companies to manage the volatility and take control of business planning. Basically, what we have right now, what's observed is the working capital decisions are making absent of any real information. And that's not a good thing. Good news is, among those companies where Treasury and Finance are sharing data interactively, among companies where this networking concept is in place, one of the little facts that I pulled out of this thing, which really amazed me, is a 95% discount capture. I mean, that's phenomenal to me. And even companies that are proactively trying to take more discounts rarely can achieve this. And that's for two reasons. One is perfect information gives you the perfect confidence to make a decision. The higher quality of the information, the higher probability you're making the right choice. But secondarily, if your system is set up to do this, you're looking at the discounts that you can take in your payable system as an investment opportunity. And if you can measure the return on that investment in the Treasury Department, if you can incent the people in payables, you're going to change the behavior and you're going to get this. The good news is some of these technology changes put in place to achieve these sorts of things basically get paid for themselves out of things like this increased discount capture. And I'm going to hand off to Steve now so he can talk a little bit more about how these systems can be set up and what the returns are likely.
Thanks, Craig. Good morning, everyone. Can you hear me okay? Great. Well, thanks for joining us. As Craig said, can you turn the volume down just a little bit? Thanks. I'm with Areva, and so Craig's expertise is on the financial side. My expertise is on the technology and the interconnection piece. And he started off by kind of giving away the punchline for today's discussion, and it was around the notion of being able to improve communication and collaboration between the various departments and using that as a mechanism, if you will, by which to improve cash management. And so for years, Areva has promoted this notion of what we refer to as a networked economy. Other organizations have picked up on that, most notably folks like McKinsey and Harvard Business Review. But basically what it comes down to is when you think about a networked economy, or a networked enterprise, it's about having technology in place that allows the right people to have access to the right information at the right time and give them the ability and enable them, if you will, to make the right business decisions. And so that's a big part of what we're all about. And when McKinsey did some studies on this, independent of anything that we've done, they interviewed approximately 4,400 executives across various industries, and what they saw is pretty impressive. When they looked at organizations that fully embraced the notion of a networked enterprise and the networked economy, 50% of the people the companies that they surveyed saw an increase in sales, higher profit margins, greater market share, and were more likely to be considered a market leader as a result of the benefits that came about as a result of that interconnectivity. So historically, collaboration between organizations has been a struggle. I'm sure many of you have encountered that in your professional lives. It's hard enough to get people inside the four walls of your own organization to collaborate and communicate. It gets that much harder as soon as you start to leave the firewall or the four walls of your organization. I'd be willing to bet that everybody in this room today works for an organization that has probably invested millions of dollars and thousands of man hours in various systems that were designed and put into place to address these kind of issues. Mostly collaboration and communication within your four firewalls. ERP systems are fantastic tools for doing that. And as I said, I bet most of you have got an ERP system of some type that you've dealt with. And they do a great job. But one thing that people may not realize is that 20 to 40% of the data that's necessary for ERPs to work effectively actually comes from outside the four walls of your organization.
What was that percentage again?
20 to 40%. It's pretty significant. So if you think about the amount of money and time and effort that you invested in that system, and right out of the gate you realize that that I've got potentially a 20 to 40% deficit in terms of the kinds of data, the validity of the data that's coming in because of collaboration issues, that puts a crimp in how you look at your investment. You couple that with the idea that 80% of the business transactions that occur between organizations are still done in paper format. So think about that. When was the last time any of us sat down at the table, the kitchen table on a Sunday morning, and got a pen out and filled out an order form for something that they saw in the Sunday paper, and wrote your address down and ticked off what you want to buy, and then wrote a check and wrote an envelope and put a stamp on it, and then walked out to the end of your driveway and put it in the mailbox, and then came back and sat down in your chair and patiently waited for whatever it was you ordered to come show up. You have no visibility into whether that organization ever got your envelope, unless they cash the check, and in which case hopefully you see the check cashed after you get the item. But you've got no visibility. You don't know how they've shipped it. You don't know when they shipped it. I mean, does anybody do business like that anymore? I mean, on a personal level? I mean, you find it totally unacceptable, right? Amazon, among others, has totally changed that. You can go online and look to confirm that the order got there because you put it in directly. You know the payment got there. You know when it's going to ship. All the great things that you care about personally are there. On the business level, a lot of that doesn't exist right now. It's primarily because of a result of the inability to effectively collaborate and have visibility into each other's systems. And so there's a couple of ways a couple of implications that come about as a result of that. So if we go back to the paper example, if you're getting 80% of your invoices or business documents into your four walls manually, they've got to go into that electronic system that you just spent a whole bunch of money on to get full use out of it, which means somebody has to rekey that information into the actual system, the ERP system. That introduces costs. You've got to hire people to do that. You have to have facilities in place for them to work in an effective way. It introduces errors into the system because people are people and we make mistakes. And so you're introducing delays into the system. You're introducing errors in the system which now have to be fixed. And so now you're introducing more people that have to go back in and address the errors that are there. And the data becomes stale and inaccurate and incomplete very quickly. So it's not a good situation. Now, it's what we've all lived with for a long time, but what we propose and what industry analysts are seeing is there definitely a better way to deal with this. Now, some of you may be familiar with EDI, have heard that term. So it's electronic data interchange. It's been around since the 80s. It's a very common tool used in larger companies, but it's not for everybody. Only about 20% of a company's trading partners are able to use EDI, primarily because of the costs associated with it and the complexities. It requires some really smart people to keep EDI up and running. And just as a kind of a sidebar on that, schools aren't pumping out EDI technology people. It's boring stuff. They want to work on web design and all this, the latest and greatest. Making electronic documents move from one computer to another just isn't all that exciting anymore. The other issue with EDI is that it tends to be point to point, so you don't get to leverage this investment that you've made from a technology perspective. And fundamentally, in most cases, EDI is what we call non-intelligent. It's a dumb pipe. It moves from here to there, and it's got technology rules in it to make sure that the formatting is correct, so when my computer talks to your computer, they speak the same language. What it doesn't do, in most cases, is speak business. So it doesn't know, or couldn't care less, that the invoice number is incorrect, or it doesn't match with a certain PO, or the units of measure are off. There's a whole host of things that it just doesn't have any notion of. And so basically what you've done is you've got bad information into your system faster. So that's not necessarily a good situation either. So as a result, what you end up with is inability to effectively, or a lack of visibility into the various systems. As Craig was saying, you don't have the ability to see ahead of time when orders are being placed, what kind of payment terms are being delivered, when payments are being instituted, whether you have the ability to capture early payment discounts. And so as a result, millions of dollars end up getting left on the table, all because you don't have the visibility at the level you'd like. Could you give me that water? Thank you. Sorry about that. I talk too much, I get dry here. So, okay, so, all right, so fortunately there's a lot of technology improvements have taken place over the years, and there are better ways to deal with this. And specifically, it's the notion of the business network, which I referred to earlier, the networked economy. And basically what the business network is about is facilitating communications between a buying organization and their various trading partners. And this is across the board, from everything from automating and digitizing all those business documents that we talked about earlier, making sure those are all in a digitized fashion that supports automation and the clean flow of communications, which then provide the visibility and the collaboration that gives you folks the information you need to start to manage cash. So an effective business network typically has three areas of value that it will deliver: automation, collaboration, and visibility. So on the automation, I alluded to this earlier. One good example of that is specific to those business documents. So e-invoicing is something that you may have heard of. A lot of companies are going to working with their suppliers, their trading partners, to get them to deliver their invoices in an e-format to bypass all that paper that typically takes place. And so what does that mean to you folks? Well, the invoices that are coming in through a business network, by the time they get to your teams, there's a very high probability that they're accurate, and from a business perspective, they reflect the terms that were originally intended. And the reason that can take place is because a business network, as opposed to EDI, has intelligence layered into it that will look at the things that the individual invoices as they go through the path and through the pipe, if you will, to make sure that they in fact do measure up to what they are, where they need to be. If they don't, then depending on the level of severity for any given error, there's a number of things that a business network could do. For example, it could send an email back to the supplier and said, hey, this invoice is incorrect, you've got the wrong date, or you've got the wrong shipping address. We're going to let it go through, but you need to fix it next time. That invoice goes into your process for approval. But it can go all the way up to something where it's catastrophic or severe enough where you kick it back to the supplier, and the supplier has to fix it before it can be resubmitted. Now, there's some key advantages to that. So on the surface of it, you might think on the supplier says, well, wait a minute, you're kicking my invoices back, now I got to start from zero. Well, that's true, but you know exactly why, and you knew pretty much instantaneously that I have a problem, I have to fix it, and if I fix it quickly enough, I can get it back into the system, so my net 30-day terms, or 45, or whatever they are, start counting when I think they're counting, not because a paper document was sitting on somebody's desk and it took them 2 weeks to get to it. So an example of how powerful this is, if the cross-industry average for invoice approvals, when they're paper-based, is on the order of about 20 to 22 days. So from the time I send an invoice in to you and hope to get paid, before anybody on your business side gets the chance to look at it and approve it or say no, it's 22 days because it's floated around and somebody had to check it and all these various things that go on with it. In an electronic situation with a business network, it's down to about 4 days. So what that means is You have, as financial folks, you are now in a position to make a decision as to whether or not you want to make a discount decision relative to a specific supplier, assuming you've got a discount system in place with that particular supplier. So, for example, the net 210, net 30, if you can't approve an invoice for 22 days, you've already lost your shot at getting that money off the table. Yes, sir.
This may be a leading question, but
I like those.
We're pretty blunt about EDI. We use EDI, and I don't disagree with your assessment of it, but it has one major advantage, which is it's sort of an industry standard, and you have a broad base of companies in all industries that use it. What's going to replace it? How do you get a lot of what you're talking about is great, but it's only great if everybody's using it or critical mass.
Sure. Well, so a couple of things that you just said. So first of all, when you talk about an industry standard, there's no such thing. I mean, there's a document, and I mean it in EDI, I mean it almost anything. When somebody says the word, it's an industry standard, you immediately...
It's a commonality.
Yeah, there's some commonality to it. But the fact of the matter is, when it's not a standard. So that means, and that goes back to the 20% usage rate. The reason it's so few suppliers are able to leverage it is because it's not a standard. It's a set of guidelines that allow people to talk in a common language. But at the end of the day, if I'm a really, really big retailer and I make issue an edict that says the only way you're going to do business with me is through EDI, every one of those suppliers, whether it's the really big guys all the way down to the mom and pop shops, of which there are many, has to figure out how to work with that so-called standard. And it's not a standard because that really big retailer has got his own version of how they want to do EDI. And so it becomes very difficult and frankly impossible for everybody to use EDI. And so the trick is, to your point, is you've got to have a system in place that enables everybody to participate. You want to get as close to 100% participation as possible. And as I get into a couple more slides, I'll talk about how a good business network will do that. Did that answer your question?
Yeah, I'm interested.
Okay. I better figure out something before I get there. Yes, sir.
For companies that are interested in EDI, I've seen one of the large holdups being the stupidity of their AP system, and that there's no banking information in there at all. So payments cannot be transmitted electronically. So if you wish to pay using a CTX or CPP type of format, you can't do it because you have no banking information. How do your system or other systems help a company actually get into EDI, collecting that banking information, and of course,
Well, so part of what our network, or a good business network, does is has capabilities to deal with the fact that there's different types of data coming in. And banking information, if I understand you correctly, there's the notion of keeping track of things like routing numbers and bank numbers, all that stuff. So part of what a good business network will do will have that in there and be able to facilitate it if the ERP systems don't. The more modern ERP systems do have that capability, but a good business network will layer that on top of it to fill the gap.
I mean, I know SAP can do that,
Yeah.
but the information has to be there.
Right.
Collected is a function of management and having the resources to do that. And if it's too hard, they just don't, and they don't, they just blow it over.
Well, right. And so specifically, I think what you're referring to is now if you want to be able to make electronic payments, then you run into issues with that. And so, this is not supposed to be a sales pitch, but part of what we do is deliberately or specifically goes.
Workflow issue as much as it is a system.
Exactly. And a good business network will provide that workflow as part of what we do.
Is that something you can help?
Yeah. Yeah. How are we doing on time? Am I doing okay? Okay. Speed it up. Okay. Okay. So let's see here. So let's look at some of the benefits that come about as a result of leveraging a good business network. And just to reiterate, because I got sidetracked a little bit there. I apologize. But so the three things that we talked about in terms of benefits are the automation, the collaboration, and the visibility. So on the collaboration piece, a good business network, to a couple of your points here, it facilitates many-to-many communication. And so it makes it easy for a buying organization to communicate and collaborate with all their trading partners and take advantage of the fact that you now have visibility into this. So for example, one of the companies that we work with is a chemical distributor that quite frequently drop ships their chemicals directly from the manufacturer to the end customer. From a distributor perspective, it's great because I'm not taking any inventory, right? But there's issues associated with it because prior to having any kind of collaboration in place, the only way they knew the order got there or didn't, which turns out was fairly frequent as well, was when they got an invoice from the distributor or the manufacturer. Or they would call the end customer and say, hey, did you get the stuff? And then they would be able to issue an invoice and initiate the payment process. What they were able to do with the business network was everybody was connected. And now when the manufacturer sent the product to the end customer, they sent out an advanced shipping notice that went to the customer. It also went to the distributor. The distributor now had visibility into the fact that it had been delivered, and they can initiate their payment the receivables process, and they shortened the DSO by 5 days. The other thing that came about as a result of that is that because the field people had visibility into this stuff, they were able to manage expectations of the end customer more effectively, which drove up their customer satisfaction statistics and ultimately resulted in an increase in sales. So, as we said earlier, it cuts across a broad range. Yes, sir?
It all theoretically sounds great, but how do you get your business partners? If you want to go into this, you have 1,000 business partners.
Tens of thousands.
How do you get them on board?
So that's a great question.
How do you communicate this to them, and then they have to change their systems, they have to do things, it just almost sounds like a panacea or being ivory tower.
Well, no.
Get a couple of them, to get on board with you, but I would think my business partners, 98% of them would see you're crazy.
Well, so, all right, so again, I'm going to have to divert a little bit here because it's not supposed to be a commercial, but Areva has over 1 million suppliers on our network. And to your point, it's extremely valid, and it's a critical component, because if all your suppliers and trading partners say you're crazy, it's not going to work. So part of the value of the network, and as you evaluate business networks, part of what you need to look at is how well are they going to help you, to what extent are they going to help you enable your suppliers. We've got a whole team globally that does nothing but enable suppliers. They walk them through the process, they hold their hand, they talk to them, tell them this is here are all the good things why it's good for you as a supplier for a buying organization. And we do 99% of the work. Now there's some change management that has to take place, and I will tell you that it's a hard job. Your point is very well made. It's not easy. But we have over 1 million suppliers on our network, and some of the largest companies in the world are using our network specifically because
I can see the large companies doing that, but I don't see the small guy.
Well,
we're dealing with, maybe, we're a major, maybe not a major customer of his, but he'll ship us a number of times a year, so a significant amount of money.
Yep.
Of product. How do you convince a guy like that?
Well, so there's two sides of the equation. There's the buy side, which sounds like that's the side you're on. You're the buying organization. But you've also got to sell it, right? So you're both of those, right? Yeah, it's hard to make a business doing just one. So on the supply side, you have to go through this whole enablement thing, and as I said, to a large extent, it's educational. We have systems in place, and I'll talk about this real quickly here. But the technology is set up in such a way that it supports the large guys all the way down to the small guys. So for example, the small guys that don't have the technology infrastructure, they don't have the really smart people with the pointy hats in the back room figuring out how to make all these things work together, we've got portals. Now this is not a portal that you might be used to, because some have supplier portals where they go in and put the invoice in, and it's a one-to-one connection between a buying organization and a given buyer. The difference between our portal and that is because it's a true network, excuse me, it facilitates communication to all your potential buyers. So if I come on board as a supplier, I now have the ability to communicate with every other buyer that's on that network if there's a relationship established. So you get to leverage your effort.
And I think that's the primary difference between an EDI concept or an electronic bill presentment and payment concept, where it's a series of one-to-one and you incur the effort and expense and the format negotiation with every new person that joins. If you are joining a network, you establish the hub and spoke. Once you've established your conduit, you are now open to all the customers and all the suppliers that participate in that network. The object is to make the cost and effort of getting connected that first time. You can tie it, basically it's justified by that one business relationship, but the ongoing benefits basically continue to pay you for that.
Does that make sense? Okay, so couple of things, so what are the benefits to this? So let's look at one particular area, and that's discount management. So what we've seen in our studies, and as a result of all the customers that we have, being able to benchmark all that data that flows across our network, just as an aside, the economic value of the transactions that flow across our network are in excess of $450 billion. So it's not an insignificant amount of information that we're able to mine as part of our benchmarking efforts. And so one of the things that we've seen, and it was borne out in the McKinsey report, is that for the companies that have fully embraced the whole notion of the networked economy and the networked enterprise, you see an increase of suppliers that are willing to participate in discount programs from 1 to 3 or 5%, all the way up to 25%. Significantly expands the pool of money from which you can start to pull on from a discount perspective. The other thing that I think is fascinating is 95% discount capture. This goes back to the notion of paper not being able to know ahead of time or react quickly enough to discounts that your purchasing department has aggressively gone after. Prior to this, you can see it's about 10% capture, the laggards. We've got customers, I'm going to give you an example of one here, that's actually 98%. 95% is kind of our baseline. If you do this right, you should see about 95% capture of discounts. And then the other thing I'll point out here is that when you do that, the average return that we've seen as a result of that is 24% return on the cash. Yes, sir.
One more question for everybody here also, because what I'm seeing in our business is that we very rarely know all the discounts. With interest rates so low, nobody's offering 1%, nobody's offering 2% as opposed to 5, 6 years ago.
Yep.
Getting that, I mean, the number of our vendors offering discounts, I would say now might be less than 1%. They just don't want that because they can borrow at lower rates than what they're going to discount us at.
So that's a valid point. The reason that folks typically do this, and you know far better than I do, is because it's typically for cash flow. So if they have access to the cash, then it makes sense for them to borrow it. But a lot of companies that we're seeing, our suppliers that participate, still don't have access to that cash yet. It's we're not out of that recession yet, in spite of what some of the numbers say.
Yeah, and now that Bernanke and others are making noises about eliminating the QE.
Right.
The
3-4
interest.
years from now, I'm sure they're going to be
Right.
they're going to be offering discounts again because interest rates are going to be,
Well, and this gives you a system that allows you to manage that effectively. So just real quickly here, because I think I'm about up against the rail here. I stole some of Craig's time, I'm sorry. So at the end of the day, what we see, if you look at $1 billion in targeted spend, there's $10 million of savings and increase in working capital that can come about as a result of embracing this whole notion of networked economy. About $1 million you will get out of pure efficiencies, process-based efficiencies. You'll get, as we mentioned earlier, about $2 million in discount savings. You'll see a $3 million impact on your working capital for every $1 billion. And then you'll see about $4 million that will be a savings that previously was leaking away through contract in compliance. So for about every $1 billion, you'll see a $10 million impact. So I'm going to hand it back to Craig.
Let me give you a free advertisement. I am a seller and invoice into Areva.
Okay?
I didn't have a choice. I had to do it if I want to continue to invoice those guys.
Yeah, your buyer told you you had to do it.
Sure. As a result of that,
Yep.
I get my cash about 5 or 10 days earlier. And the reason for that, I mean, the discount stuff I do, and discount can be for everything. But we get our cash 5 to 10 days earlier. And the reason we do that is because we can actively manage the invoice approval process inside the buyer system.
So is that a good thing? You like that?
I get my cash 5 to 10 days earlier, I'm happy to.
Good. Thank you for that.
And it's the reach-through effect. From our studying the situation, it's the reach-through effect that it's, you take simple things like a receiving document in a traditional segregated situation. First of all, it's paper. Second of all, it's mysteriously only known to the warehouse guys that are accepting the trucks. And that takes a long time to get back to where even their own payables department knows about it. You on the receivable side of things, I mean, you want to know if that shipment didn't get there, you can predict the domino effect down the stream of what that's going to mean. Delays in the invoice, delay in the payment. However, if you are collaboratively dealing with an electronic version of that shipping event, you will see it happening. You will know if the quantities match, the invoice numbers match, and that the payable's set up. It takes the guesswork out of it. And I think the bottom line, again, up front and behind, better information is going to give you a better view of where you stand. We were having a discussion earlier today about, what is the KPI on liquidity? And it's very hard for people to say, well, how do you measure it? There's no DSO for liquidity. And I said, well, actually, in my opinion, the KPI for liquidity is very simple, and it has to do with your bank account, and it's whether or not you're going to be overdrawn. It's binary, it's black and white, and it's actually catastrophic to some economic degree if it's not met. And the figure up front, that extra trillion in working capital that's sitting around is, to a very great degree, devoted to the uncertainty of the suppliers being unsure about when they're going to get paid. And the reaction to that volatility is just to let the capital accrue and sit unused in a pile just in case. If you have better information, if you know, it's great if it's 10 days sooner, but I would suggest that even if it's not 10 days sooner, if I know for a fact when I'm going to have it, I can make a better business plan. And that's the idea. So it's just going in two directions. And this is where this is the buyers and the sellers, you swap on all sides. It's information you can very much benefit from knowing outside your organization, but inside the organization, if you can connect your treasury department, your liquidity plan to that business information, you're going to get better liquidity plans. When you have a reliable number, the next step in the challenge is to go through to your business operations and have their actions changed based on where they stand liquidity-wise. And we're finding and we're measuring that the performance of those organizations where the business managers in the sourcing departments, the business managers in the sales areas, if they are making their policies and taking their actions based on knowledge and collaboration with the Treasury Department, the business performance is significantly improved. We're talking real dollar savings. We're also talking about expanded market share. I mean, we really didn't get into the real goodies where the business performance is improved. Better relations. If somebody is sort of dragged against their will to get into this network and then find out they're getting paid sooner, it's good for everybody. Treasury Today has an Adam Smith Awards every year, and I'm very proud to say that most of the awards over the past few years have been achieved by companies that are taking this approach. So the best working capital APAR solution is Roche. These are people that are making that connection between their operational systems and their treasury systems, and then using the insight they get from their liquidity plan to change the way they do business. And it has a direct impact. I'll walk you through just very quickly a couple of examples. And these are companies that are doing this in both directions. They're using this network concept. And I mean, like we're talking about, there is an Areva network, but this network concept is not just join a network, it's connectivity, and that means inside the company. And you want to connect and bridge that gap. We saw in the beginning the silo, you're buying and you're selling and your treasury in different areas. Once all of that is connected, business benefits come out. The bottom lines here, it's like you get a 30% reduction in BPO costs, 75% reduction in AP costs. That's what's going to jump out at you the first time when you start operating under this paradigm. But I think the business benefits further on are even more impressive. So, quick recipe for all of this in terms of how we've observed companies go about this. First thing is you got to know your global cash position, know your anticipated sources and uses with a high degree of reliability. Everything starts from there. So in order to do that, you want to include your full sourcing and sales data, which means not just informing your cash plan based on your pending AP vouchers, but to actually go back into your sourcing systems and, if possible, go right into your supplier systems to know. That's going to give you a much more reliable forecast. Once you've got those reliable liquidity forecasts, you need to be able to take action. And so here, what you want is your working capital systems to be informed by the liquidity state of the company, and that your policies are going to change month to month. Most people, how often do you set your credit terms? How often do your suppliers set the credit terms? I mean, once a year, if that. If you're able to dynamically change your activity based on where you stand this month, when you need cash to be accelerated, if you call up your customers and say, hey, you're talking about the 3% to 1% of your supplier vendors that are offering you discounts. How is your customer going to react if you call them up and say, hey, I got a one-time deal for me. If you can pay by Friday, I'll give you 1%. How do you know that you need to do that? It's by understanding what that cash position is going to be. And then finally, it's like in those working capital systems, how do you increase the effectiveness of payment and collections on behalf of the business? And here you want to do two things. One is minimize the waste of working capital. I think one of the Hackett figures that I saw from a couple of years ago was out of $1 billion, there's an average of 126 million in unused working capital. Just money that sits in the bank account. And I love to ask the questions, do you know what's in the bank? And most companies, they can tell you what's in most of their accounts at any given time, but it's never a complete picture. You want to know where that money is and what it's doing for you. And second of all, you want to look at this as capital. And brief conversation I had earlier today, which I thought was very enlightening, is if you want to change the behavior of your people in your payable system, your receivable system, it requires not only knowledge of the income that you're making off of that capital, but they need to have their incentives changed so that they are rewarded for working well in it. Because if I'm an AP manager, what am I usually measured on? Spend. I save $1 million, $2 million, what's the big deal? If I'm, $1 billion worth of spend and I save $2 million, okay, I saved $2 million. However, if you look at that in terms of return on capital, that $1 million is huge. And as we've seen, we've got companies that are making like a 25% return on their working capital now when they're doing it intelligently. And you can't get that return anywhere else. So, oops, that's the off button. There's the next button. So, appreciate the questions that have taken place during the presentation. I know there's probably a good half an hour here after this, and I'm happy, as I'm sure Steve is, to have conversations. But if we'd like to have a more formal Q&A now, if anybody has any further conversations that you'd like to continue on anything that we've discussed here.
I would like to understand from this gentleman who said he was dragged into the network and he benefited from this. But I would like to understand what was the burden on his organization in terms of implementing this network.
Are you willing to talk about the process and the effort that was required to get into the network?
One of the things that was disappointing is I don't think the buyer spent enough time training us as to how to get involved in Areva. But the burden was, one of the burdens is it moves the process from the buyer down to the seller, that we've got to spend a lot of time getting accounting codes and getting approvals and the accounting code for all that stuff. There has been an increased burden on us because we're doing some of their accounting. But, you know, it's something we can live with, and first of all, we don't have a choice, but it's something we can live with, and, you know, it's like you learn anything. I mean, it gets better, and there's good benefit. And the real benefit is we can see our invoices moving through their system, whether they're getting approved, whether they're getting kicked back, why they get kicked back. If they get kicked back, then we get an email that says your invoice didn't get approved. So, you know, this is real-time information so that we can, so I like it. I think it's great for us and stuff.
But doesn't it make you use basically two systems, one for this specific vendor and everything else for everything else for the other vendors?
That's actually not true, because what's happening to us as a seller is that every one of our buyers is using a different system. So, you know, these guys are Areva, but all our other clients, we've got 4 or 5 different systems that we're importing.
Yeah, I think one of the benchmarks was that some of the best-in-class people were achieving about 25% participation. So even among the best, 75% of their business is still happening outside. And it's the cumulative network effect. We found that those companies are, that effort for even that 25% or 10% or 5% is paying for itself. They're not burdened to the point where they're not achieving more benefit than they're investing. And, you know, our suggestion is that there's a cumulative impact. There's 1 million, how many suppliers? Over 1 million. When that becomes 1.5 million, 2 million, it only accelerates the benefit for those that are already participating. What we found in the benchmarks is that it does pay for itself, that effort, even though it's only marginal. The other piece of this that I would say is important is that this whole idea of getting that sourcing information into your liquidity plan, you don't have to go outside the walls. I think most companies I've seen, like they'll take the vouchers, but that's it. Having the foresight to go out there and collect the sourcing information as it's occurring, likewise getting into your sales order management system and understanding the deals that are being negotiated, it creates a forecast that's not just valid 2 weeks into next month, but it's actually good for the quarter. Now your treasury people are making more intelligent decisions about when, you know, do you set up borrowing, do you make some investments, and how much of that capital is going to be taken back to the AP department and say, here, you can do things with us now. Feel free to use this money. And maybe this month, no, you can't. We're a little short. And maybe you go back to the receivables department and start setting up factoring relationships or offering incentives for people to pay early. All of which is a better opportunity to make those decisions that right now aren't being captured, and we're seeing a positive payback for the people that do make that investment.
I just have one Areva question. What's the average size of the supplier in the network in terms of revenue, or I don't know?
You know, I don't know the answer to that question. We've got a broad range from, you know, the folks that are very vocal about it, like IBM and Dell, all the way down to mom and pop shops. Literally, I mean, one, you know, sole proprietorships working in the garage, and everything in between.
Yeah, and if you look at, you know, you take an EDI format, I mean, that's one of my favorite topics of discussion, you know, EDI as a standard. Yeah, the communication is a standard. What does that document look like underneath? And for every EDI exchange, you've got to figure out which part of the description holds this and that, and you've got to parse it. The effort that it takes to establish an EDI connection is no different in general magnitude than the effort of creating that ability, a reusable connection to every other supplier that joins that network.
So I only have one Areva relationship. So if I get other buyers who are also using Areva, is it going to be the same format? I mean, is it?
Yeah, you're connected. So that's the you know, the whole network piece.
When you're talking about EDI, everything's different. Areva is
Yeah, no,
consistent.
You're connected to the network, and then inside the network, we handle the various manipulations that are required to get it to this buyer and that buyer. It doesn't work that way with EDI.
Yeah, and then
Once you're connected, you can also start working with your own suppliers, to get them coming to that point.
Right, exactly.
Right. And the other opportunity that we're now, one of SAP's other large customer bases, in addition to commercial enterprises that are trading with each other, financial institutions. So, we're able now to, we've got Citibank involved, Royal Bank of Scotland, a few other these larger banks. The objective is now that you're going to be able to offer financial services, and so now instead of, having a specific bank account and a route to make a payment, if you've got a cross-border payment that you're going to take place, why shouldn't you see an offer and get a better rate from a different financial institution to execute? So the opportunity for building additional value into that network based on, that one-time investment of getting into it is going to be able to have cumulative effects downstream that do not require any effort on your part to enjoy. And we haven't even started to talk about the connection on the backside of currency deals, interest rate swaps, and other things that can be automated, generated automatically based on, if you're making a payment in a particular currency, the deal to buy that currency can be executed automatically without burdening the Treasury Department to do that. Huge savings and costs in terms of administering the Treasury, and you get more accurate, more reliable hedges, and all the compliance reports are generated automatically. So the throughput from beginning to end is considerable. Well, thank everyone very sincerely. I think there is a thank you slide. Thank you very much for your time. And I know Steve and myself would be very interested in conversations that we might want to have during the rest of the conference. Thank you.